It's another edition of the Trading Tips video newsletter, teaching you how to become a successful trader today. This video newsletter is brought to you by firsthourtrading.com.
Welcome to this edition of the TradingTips.com video newsletter. In this episode, we'll be examining volatility indexes, what they are, what they measure, and how they can be used as predictive indicators. Without further ado, let's begin. The Chicago Board Options Exchange measures the implied volatility of a number of indexes and ETFs. Most famous is the S&P 500s, which is widely known as the VIX. But the VIX isn't the only volatility index. The CBOE also calculates implied volatility for crude oil, the NASDAQ 100, the Russell 2000, gold, the Dow Jones Industrial Average, and a handful of others too. Implied volatility is determined based on a complex formula that's beyond the scope of this episode, but it is important to understand the basic concepts. The idea is to measure how much traders think the index being measured is going to move in either direction over the next 30 days. To find this result, the VIX and other volatility indexes look at the demand for near-term and next-term puts and calls. The greater the demand for puts and calls, the greater the anticipated movement of share prices in either direction. Since volatility can be in either direction, up or down, you might think the volatility indexes like the VIX are market neutral. You'd be wrong, though. Here we see a chart of the VIX, but with the S&P 500 in black. Notice the inverse relationship between the VIX and the S&P. The VIX tends to go up when the S&P 500 goes down and vice versa. And here's why. It's because the stock market typically rises at a slow and steady pace and then plummets with speed. It's like a roller coaster going up slowly and then dropping fast. Bull markets last longer than bear markets. Corrections tend to be brief and pronounced compared to uptrends, so volatility tends to be negative more often than positive. But remember, what implied volatility actually measures is traders' anticipation of volatility, which is based on how much they're willing to pay for calls and puts. They're willing to pay more when they expect more volatility. Furthermore, panicky investors buy more options. They buy puts as insurance or as a bet against the market. Buying puts directly affects implied volatility. So how can you use volatility indexes to inform your trades? Well, this example shows a chart from September 2008 with the VIX on top and the S&P 500 below. Look at the VIX portion of the chart. Notice at the left, the VIX breaks out of its range and then establishes a new range. From this point on, when the VIX nears its upper range, that's predictive of a reversal towards its lower range and vice versa. Since the VIX trades inversely with the S&P 500, this means that when the VIX approaches its upper range, that's bearish for the VIX, which is bullish for the S&P, and vice versa. Compare how the S&P 500 fared at each point of excessive bearishness. It tended to embark on an uptrend. Then look at the very most recent excessive bullishness incident. It signaled an S&P 500 peak followed by declines. Implied volatility can be eerily predictive. On May 6, 2010, at 2:45 p.m. Eastern Time, the Dow Jones Industrial Average suddenly crashed by roughly 1,000 points, about 9%, only to recover these losses in minutes. The flash crash, as it was called, had little impact on the Dow's daily return, but it wiped out tons of traders who saw stocks fall well beneath their stop losses, only to pop back up. What's crazy is the VIX seemed to predict this. It started trending higher on May 3rd. The May 6th flash crash is just a blip on the S&P 500's chart since it was over in a matter of minutes, but it created a huge spike on the VIX, and that was predictive going forward. While the VIX is the most popular volatility index, there are other volatility indexes too. Here we have a chart of the so-called gold VIX, or GVZ, which measures the implied volatility of the GLD ETF. GLD is shown here in black, and you can see how it has typically traded inversely to GVZ in the candlesticks, and how at certain junctures, GVZ seems to project GLD's future movement. In conclusion, volatility indexes measure implied volatility, which is the amount of volatility options traders expect. Volatility can be in either direction, up or down, but high volatility tends to be bearish since stocks tend to fall faster than they rise. Over time, implied volatility typically establishes a normative range, and moves towards the extremes of these ranges tend to predict reversals. We hope you've enjoyed this episode of the TradingTips.com video newsletter. Thanks for watching and good trading.
This Trading Tips video newsletter has been brought to you by Manny Backus's First Hour Trading System. Every day there's money to be made in the first hour of stock trading. This is the world of day trading, not for novices, unless you have a system. The First Hour Trading System. Visit firsthourtrading.com now and sign up for a free 30-day trial. You could make enough in the first hour of your day to take the rest of the day off. View more Trading Tips videos. Visit tradingtips.com. Sign up for our free video newsletters and become a successful trader today.